Over the past several weeks, the message from this channel and from many others has been that the stock market is overbought and extended to levels that we've not seen in years. A correction was becoming more likely, and that everyone should proceed with caution. Regardless, the stock market continued to push the envelope higher, as it tends to do with Fed support. The continuation higher leaves the impression that those calling for caution were flat out wrong. However, examining history, there are only a few times over the previous 2 decades and more where investors and traders were so extremely lopsided in their positioning. So while the fund manager's survey shows cash balances at 6-year lows, the stock market seems to have stumbled last week. So let's take a look. Last week, the stock market began to struggle with the prospect of coronavirus. And as the recording of this video, the virus continues to claim victims, even with unprecedented measures for containment. If you want to know more about the conditions of the virus, you can check out the multitude of other channels offering information. And although the human cost of the virus is not lost on me, we are here to better understand the economic impact. And that impact seems to be growing with news out of China that with the open of the Chinese market, the Central Bank of China said it will inject 1.2 trillion yuan, or about $174 billion worth of liquidity into the markets via reverse repo operations on Monday. In addition to the injection, China's securities regulator has reportedly notified brokerages to suspend short selling of stocks from Monday until further notice. Investors in China are bracing for a volatile session following the break from the Lunar New Year, which was extended by the government with the outbreak of the coronavirus. China is facing further isolation as other countries introduce travel restrictions, airlines suspend flights, and various governments evacuate their citizens. These actions compound an economic slowdown in China that had already begun. Though some potential good news came from doctors in Thailand who have seen success in treating severe cases of the new coronavirus with combinations of medications for flu and HIV, with initial results showing vast improvement 48 hours after applying the treatment. This is said not to be a cure, but will be applied only to severe cases. I want everyone watching this video to know that the coronavirus is not the cause of the stock market's recent weakness. The real culprit was the excessive bullishness that led to the market weakness. In other words, stock market exuberance. To be honest, conditions were ripe for a pullback, and we talked about it several times. If it wasn't coronavirus, something else would have been the straw breaking the camel's back. The bottom line is that we shouldn't be surprised by the stock market's current weakness. On the contrary, when following market sentiment and other market signals we've talked about, we should have been expecting it. The importance of various stock market measures is not necessarily to be a timing signal to buy all or sell all positions. Think about the market and the economy in this way. When the stock markets are rising, the economy seems balanced, the road ahead appears to be straight, and you have good visibility. Go ahead and press down on the accelerator. Take on more equity risk. The chances of losing money in these circumstances are lower. However, if hazards arise and the road ahead isn't straight and your visibility becomes clouded, don't ignore the warning signs and back off on the accelerator and maybe tap the brakes a bit. The main reason that investors do so poorly over time is they don't manage risk well. Risk is not a function of how much money you make when markets are rising. To me, it's a measure of the ability to survive the crash that inevitably will happen. And for today, that's ChewDog Charts. Thank you.